We will discuss capital budgeting and risk in Chapter 11. In the evaluation of an investment project, it is important to consider both the total project risk and the impact of the project on the beta risk of the firm. Be careful. We are not saying don't invest in risky projects. We are saying if you undertake a risky project, you want to be compensated adequately. So, how to adjust risk in capital budgeting? By looking at the decision criteria presented here. For riskier projects, we can raise the discount rate, that is the required rate of return, or adopt more conservative estimates for net operating cash flows. The risk adjustment procedures presented here are appropriate when a firm believes that a project's total risk is the relevant risk to consider in evaluating the project, and when returns from the projects are highly positively correlated with returns from the firm as a whole. Many firms combine net present value with payback when analyzing project risk. With this approach, a firm may decide not to accept projects unless they have positive net present values and paybacks of less than stated length of time. Several weaknesses are presented with this approach. First, the choice of payback criterion is subjective. Second, payback criterion fails to recognize that some projects are riskier than others during the startup periods. Third, this approach may cause a firm to wrongly reject acceptable projects. A firm can use the simulation technique to generate a probability distribution for the project's net present value and to compute a mean and a standard deviation. Given the information, it is possible to compute the probability of an outcome of interest. For example, the probability that the project's net present value is negative, that is, less than 0. If the project's net present value is normally distributed, we can use z-scores to calculate the probability of an outcome of interest. This slide provides an example of using the simulation and the z-score to analyze the probability of an outcome of interest. We are interested in the probability of the net present value less than 0. That is, we can write it as the probability of net present value is less than 0, because the net present value is normally distributed. We can transform it to the z-score by subtracting the expected value and then divided by the standard deviation. That is, we want to find out the probability that the z-score is less than -2. We obtain the probability equal to 2.28% from the table at the back of the textbook. We will show you how to obtain this value using the table in the next slide. In the example we just showed in the last slide, we want to find out the probability of the z-score less than -2. We obtain the probability by looking at the value corresponding to the z-score of 2. Practice problem. You are required to find out the probability that the project will have a negative net present value. That is, we are interested in the probability of the net present value less than 0. Because the net present value is normally distributed, we can transform it to the z-score by subtracting the expected value and then divided by the standard deviation. That is, we want to find out the probability that the z-score is less than -2.5. We obtain the probability equal to 0.62% from the table at the back of the textbook. This is another practice question. You can apply exactly the same steps we just illustrated to obtain the solution. The solution with detailed steps is provided. A firm can also use the sensitivity analysis to estimate the change in the net present value given a change in one of the cash flow elements. The analysis provides the decision maker with the information how sensitive a project's return is to changes in a particular variable. For example, by using the sensitivity curve, which is a curve expressing the relations between the net present value and the variable of interest. This slide shows that for this particular project under consideration, the net present value is more sensitive to changes in the product price than changes in the firm's cost of capital, because the slope of the sensitivity curve on the left panel is steeper than the slope of the sensitivity curve on the right panel. The sensitivity analysis just discussed considers the impact of changes in key variables one at a time on the value of an investment project. The scenario analysis discussed now considers the impact of simultaneous changes in key variables on the value of an investment project. For example, we may consider 3 different scenarios for a project, which are the best case scenario, the worst case scenario, and the most likely case scenario, with the net present value from each scenario and the probability associated with each scenario. We will be able to calculate the expected net present value and the standard deviation for the project using the technique introduced in Chapter 8. Now, assuming the project's net present value is normally distributed, we can again use the z-score to calculate the probability of an outcome of interest. This slide provides a numerical example of the scenario analysis just discussed. Boeing's 787 investment project may yield $10.1 billion with 20% probability, negative $11.4 billion with 20% probability, and $1.3 billion with 60% probability. By using the technique learned from Chapter 8, we can calculate the expected net present value equal to $0.52 billion and the standard deviation of the net present value equal to $6.87 billion. Now, assuming that the net present value is normally distributed, the probability that the project is unacceptable, that is, the net present value is less than 0, can be calculated using the z-score technique illustrated earlier. The detailed steps are shown here. After calculation, we obtain that the probability that the project is unacceptable is 46.81%. Another common procedure for dealing with risk in capital budgeting is to reduce the forecasts of cash flows to some conservative levels. A certainty equivalent approach is to convert expected risky cash flows to certainty equivalent amounts, which are cash flows to be obtained with certainty. Now, when computing net present value using certainty equivalent cash flows, the discount rate should be the risk-free rate because there is no risk associated with these cash flows. A certainty equivalent factor, defined as the ratio of the certainty equivalent cash flow to the risky cash flow, is applied to obtain the certainty equivalent net present value. The certainty equivalent factor is between 0 and 1 because the worst case is that you are going to get 0 out of the expected cash flows for sure, and The best case scenario is that no uncertainty is associated with the expected cash flows. This slide provides a numerical example of calculating certainty equivalent net present value. We multiply risky cash flows with certainty equivalent factors to obtain certainty equivalent cash flows. We then use certainty equivalent cash flows and risk-free rate to obtain net present value. Here is another example of calculating certainty equivalent net present value. We multiply risky cash flows with certainty equivalent factors to obtain certainty equivalent cash flows. We then use certainty equivalent cash flows and the risk-free rate to obtain the net present value. Now, instead of adjusting risky cash flows to deal with risk in a capital budgeting, a risk-adjusted discount rate is proposed to calculate the net present value. A risk-adjusted discount rate is defined as the risk-free rate plus risk premium. The size of the risk premium is subjective. A project can be viewed as a separate meaning firm. The beta concept introduced in Chapter 8 can be used to determine the risk-adjusted discount rate for individual capital budgeting projects. So, risk-adjusted discount rate for the project J can be written as the risk-free rate plus the beta for the project J times the market risk premium. Projects that are highly correlated with the firm's returns on its existing assets will have a beta similar to the firm's beta. Therefore, for the projects financed with 100% equity, the appropriate discount rate for these projects is the firm's cost of equity, calculated using the security market line. For projects that have more risk than the firm's average risk, the beta used in calculating the cost of equity should be adjusted higher. So, the appropriate discount rate for these projects calculated by the security market line is larger than the firm's cost of equity. For projects that have less risk than the firm's average risk, the beta used in calculating the cost of equity should be adjusted lower. So, the appropriate discount rate for these projects calculated using the security market line is smaller than the firm's cost of equity. For projects financed with both debt and equity, we compute the risk-adjusted discount rate using the weighted average cost of capital, that is, the weighted average of the after-tax cost of debt and cost of equity, using the formula provided here. Now, how do we find a project beta? We can perform the regression analysis to estimate the beta, or we can find the beta from a pure play firm. Now, continued from the question posed in the last slide, we obtain a beta for a firm in the same investment class as the proposed investment project. If the pure play firm chosen is financed with 100% equity, and if the investment project under consideration is financed with 100% equity, your job is done. If the pure play firm chosen is financed with both debt and equity, and if the investment project under consideration is financed with both debt and equity, a two-step process is used to estimate the beta. First, unlever the beta of the pure play firm. Second, calculate the new leveraged beta to reflect the appropriate debt capacity used in the investment project under consideration. The beta obtained from the pure play firm is a leveraged beta which measures both its business risk and its financial risk. we only want to have the beta with the business risk. So we have to unleverage the beta of the pure play firm to get a pure project beta, that is, the unleveraged beta. Here is the formula to calculate the unleveraged beta from the leveraged beta obtained, where T is the tax rate, B is the market value of debt, E is the market value of equity, and BE ratio can also be viewed as debt fraction of capital divided by equity fraction of capital. Now, because the project is going to be financed with both debt and equity, the beta should reflect the financial risk consistent with the capital structure proposed for the project. So, we have to obtain the leveraged beta. Here is the formula to calculate the leveraged beta by using the unleveraged beta and the proposed capital structure for the project. Note: the leveraged beta is larger than the unleveraged beta, and the leveraged beta is positively related to debt-to-equity ratio. We can now compute the risk-adjusted discount rate in two steps. First, calculate the required rate of return on equity, that is, the cost of equity, using the new leveraged beta obtained in the second step through the security market line. The formula for the security market line is given here. Second, compute the risk-adjusted discount rate as the weighted average of after-tax cost of debt and cost of equity. The formula is given here. Let us use the textbook example to illustrate the techniques just discussed. Vulcan Industries is considering expanding into a new line of business and wants to compute the appropriate risk-adjusted discount rate for this new line of business. Vulcan's current capital structure consists of 50% debt and 50% equity. Vulcan decides to use 40% debt and 60% equity to finance the new line of business. Vulcan's marginal tax rate is 40%. Vulcan's company beta is 1.3, but its management team does not believe this beta is appropriate for the new line of business. Vulcan's management team decides to rely on the market information to estimate the appropriate project beta. They find that Olympic Materials has the risk comparable to the new line of business. Olympic's capital structure consists of 20% debt and 80% equity. Olympic's company beta is 1.5 and its marginal tax rate is 35%. Based on the steps we discussed earlier, first, calculate the unleveraged beta using leveraged beta tax rate and debt-to-equity ratio from Olympic Materials. Second, calculate the leveraged beta using the unleveraged beta calculated in the first step, and Vulcan's tax rate and capital structure proposed for the new line of business. Third, calculate the risk-adjusted discount rate in two steps. First, calculate the cost of equity for the new line of business through the security market line. The beta used is the leveraged beta for the new line of business. Second, calculate the risk-adjusted discount rate as the weighted average of after-tax cost of debt and cost of equity. The capital structure used is the capital structure for the new line of business. We are going to discuss the end of chapter questions, question number 22. Be sure to read through the problem so you will know how you can extract information from the problem to perform the calculation illustrated here. From the problem, the company API would like to find out the appropriate risk-adjusted discount rate for new projects in the financial services division. The appropriate beta should be the beta of the financial services division. However, we don't have beta information for the financial services division. We do have API's beta. A firm consists of n different divisions. Its beta can be viewed as the beta of a portfolio of n assets, which is simply the weighted average of individual asset betas. That is, a firm's beta is the weighted average of individual division betas. It is calculated by the sum of the beta from each division times the portion of total capital invested in that division. For this problem, we know that API has 3 divisions. Property Management Division with beta of 1.1 accounts for 40% of the firm's assets. Land Resources Division with beta of 1.6 accounts for 30% of the firm's assets. Financial Services Division accounts for 30% of the firm's assets. So, we can write API's beta, which is 1.2, equal to beta of Property Management, which is 1.1, times portion of total assets invested in the Property Management Division, which is 40%, plus beta of Land Resources Division, which is 1.6, times portion of total assets invested in the Land Resources Division, which is 30%, plus beta of Financial Services Division, times portion of total assets invested in Financial Services Division, which is 30%. We can solve the beta of the Financial Services Division, which is equal to 0.93. The beta of the Financial Services Division obtained is the leveraged beta with the financial risk consistent with the current capital structure of 80% debt and 20% equity. Since the new projects are going to be financed with a different capital structure, which consists of 90% debt and 10% equity, we have to obtain the new leveraged beta with the financial risk consistent with the capital structure of 90% debt and 10% equity. We first have to calculate the unleveraged beta of the Financial Services Division using the formula presented here. We have the leveraged beta of the Financial Services Division equal to 0.93, tax rate equal to 40%, and debt to equity ratio equal to 80% over 20%. After calculation, we obtain the unleveraged beta equal to 0.27. We then use the unleveraged beta to obtain the leveraged beta with the financial risk consistent with the capital structure used for new projects. The formula for computing the leveraged beta is given here. We have the unleveraged beta equal to 0.27, tax rate equal to 40%, and debt to equity ratio equal to 90% over 10%. After calculation, we obtain the leveraged beta equal to 1.73. We can now calculate the cost of equity through the security market line. The formula is given here. We have the risk-free rate of 9%, beta of 1.73, and the market risk premium of 8.3%. After calculation, we obtain the cost of equity equal to 23.4%. The risk-adjusted discount rate, that is, the risk-adjusted required rate of return, is a weighted average of after-tax cost of debt and cost of equity. The formula is given here. We have debt fraction of capital structure equal to 90%, after-tax cost of debt equal to pre-tax cost of debt of 19% times 1 minus tax rate of 40%, equity fraction of capital structure equal to 10%, and cost of equity equal to 23.4%. After calculation, we obtain the risk-adjusted discount rate equal to 12.6%. This figure shows that, using a firm's weighted average cost of capital without considering the project risk, a firm would accept Project 3 and Project 4 because they yield higher returns than the required rate of return indicated by the firm's weighted average cost of capital. However, if the project risk is appropriately considered, that is, using risk-adjusted discount rate, a firm would accept Project 1 and Project 3 because those projects yield higher returns than the required rate of return based on the project beta. We can conclude that if a firm's weighted average cost of capital is used to evaluate projects, a firm may end up accepting poor high-risk projects like Project 4 or rejecting good low-risk projects like Project 1.